Hi, welcome to the next episode of War in the Markets. Yesterday's market was a very interesting market. Huge up, Nifty up 1.5%, but FIS sold 8,000 crores. DIS matched the FIS selling, but what explains the fact that while FIS is selling, market is up? And I waited for this morning to put this update because what happened was yesterday with 2,900 stocks up and the mid cap index up 2 odd percent, the small cap index 3 odd percent, and the micro cap index up 4 odd percent. Clearly, this was a retail driven rally yesterday, and that was because of the good news floating around the war, and retail rushed in. And I will dwell a little more detail there, but I waited this morning for the Trump speech. I just heard it, and the markets have reacted badly to the Trump announcement that while he said 2 to 3 weeks the war will be over, he talked about attacking the energy infrastructure. He talked about the fact that now you can take the Hormuz Strait and energy. So overall, market has not read this at all positively. So let's go back to yesterday now. Yesterday, what actually happened was that the rally was initially a short covering rally. FIS had built up massive shorts as we spoke in our last episode. And the good news that was filtering in around the war meant that the market, when it opened up cap up, a lot of the FIs had to close their shorts. Seeing this rally in the market in the morning, retail rushed in, believing the good news, and retail traders and speculators and short-term investors came in and bought heavily through the day, obviously. But as the FIIs then realized that this was more of a short covering and they didn't see anything especially positive, and they were like waiting for the Trump speech to come later in the night, US time, they built up massive short positions from the afternoon. So that's why if you see the Nifty actually corrected down in the late afternoon because FS built up 6,000 crores of shorts yesterday. So 8,000 crores in the cash market and 6,000 crores, so 14 crores of net pressure. Despite that, the market is up. So clearly, this morning's thing, what is that showing? It's showing the gift Nifty is down 500 points as I speak now at the morning at 8 o'clock. And the dollar index has gone back up close to 100. Oil is past $106, rising up again, and US Treasury is also rising back up at 4.36. So all of this, and in the non-deliverable forwards market, the rupee has already breached the 95 mark. So clearly, the Trump speech has not gone down well, and the institutional play there, FIIs, will continue to be putting pressure on our markets. So retail, I think from a short-term player's perspective, those who rushed in yesterday, well, the English saying goes it, right? Fools rush in where angels fear to tread. I think they've got caught in a bull trap, as they call it, and today again they will face the heat. So this again brings me to the point, right? The war has to actually end, and these tweets from Mr. Trump and noises around this will cause short-term volatility, both from the FII, F&O play, as well as the retails who are trying to come and take advantage. So that volatility will be there. But unless the FII cash position turns to net buy, which will happen only when there's a clear end to the war, because these short-term moves don't make the real long FIIs invest, because even at $100, if the oil price sustains, the impact on the Indian economy and corporate profits and inflation is all quite high. While the market is discounting a lot of that, the pain is not gone until the war ends and there's a clear decline in the price of oil. So my suggestion remains the same, right? As a retail investor, right? Keep accumulating small amounts to take advantage of this volatility, but don't go and put big money, and don't take this tweet-based market rally as anything of defining change and try to put in, a bulk sum and all of that. So that advice remains the same. The volatility index is still high around the 25 levels, if you recollect, and so we have to be patient through this process of the war-related tensions playing out. Steady accumulation with a longer term goal. Don't make sector related calls, but each sector is going through its own throes of challenges. Banks, because of the rise in interest rates, and the currency pressure, RBI is again moving in, because when they put that $100 million limit, foreign banks, other banks went and transferred those assets to their corporate customers and to their HNI customers. Now RBI has again come clarification that they can't do that. They have to actually go and sell those dollars. So the rupee may see a short-term but the squeeze. Fuel prices are rising still, and the pressure on the rupee will remain from a fundamental perspective. On top of that, I want to end with one more piece, which is not very great news, but it has to be remembered. Oracle suddenly has announced a 30,000 job layoff across the world, and in India, that's about I think 12,000 jobs are off, which is 40% of their India workforce. And with 1 hour notice, they've been given 15 days per every year of service and 1 month severance pay. So this is is it AI related? Yes, but it's an AI pivot, because jobs are being lost in the AI space in the Oracle data center. So all of this has to be watched and observed. So like I said, steady microscopic accumulation is the way through this volatility. That advice remains from my end. I'll continue to keep you updating on the war till the war lasts on a daily basis. Thank you.